Hello, everyone, and welcome to KJH Insights, our monthly podcast. I am Sarah Bull, Managing Partner at KJH Investors. Thank you for joining us today on our podcast, where we provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. I'd like to welcome Andrew Csumrik here today. He's a portfolio manager and member of our investment team. Welcome, Andrew. Thanks for joining us. How are you today?
I'm good. Thanks for having me, Sarah.
Great. Well, we're really excited for you to be here after a good summer. And I just thought maybe what we would do for our listeners is reflect back on the year. So we've had a tough start to the year, but now markets are in the green. So March and April, when Trump was in the Rose Garden, that really sent markets crashing, and the markets bottomed, as a reminder, on April 9th. But then since then, we've had what we refer to as a V-shaped recovery, and the S&P is sitting at all-time highs. Now, having said all of that, Andrew, we had our investment webinar yesterday where you and Peter also talked about it being such a complex investment environment given all the crosscurrents of inflation, interest rates, and shifting global demand. So, Andrew, based on all of that, can you tell us a little bit, or tell our listeners a little bit, about what you're watching and thinking about as we head into the end of the year?
Yeah, I think you're right. It's been an interesting year for sure. After the correction in April, as we look forward, I think there's a few things that really stand out to us as you think of equity markets, maybe, or just using the S&P 500, up around 10% so far this year. It really doesn't tell the whole story. And there's a few things that really stand out. I think the first is just the fact that the market continues to be driven by these mega caps. And I use that word. It's the largest companies in the S&P 500 are really outperforming again this year. And we said in our webinar, we sound like a broken record just because we've been talking about that in 2023 and 2024. And now once again this year, these mega caps are outperforming. And this year it's really been as the AI or artificial intelligence theme continues to move along. And so this outperformance from some of the mega caps is really taking hold once again. And it means that the average stock is still doing well, but those top 10 companies are really driving outperformance there. The next thing would just be on what we're watching is the economy having some conflicting data. Probably the biggest thing is a weakening labor market. Definitely, we're seeing that. We put up what I thought was a nice visual on just over the last 18 to 24 months, the labor market and the jobs growth that we've had really stepping down. So if you think back a couple of years ago, the U.S. was growing at about 200,000 jobs per month, which we always say is a very healthy market, a healthy economy. That had stepped down to kind of 100 to 150,000 jobs. And then in the last 6 months or so, we're averaging only 50,000 job growth per month. And then add that to the massive job revisions that were announced just last week. And really what that means is about 900,000 jobs actually were revised lower over the previous 12 months. And so we actually think the economy has been a lot weaker than most have probably anticipated. And that 900,000, really, you got to go back to the financial crisis that we've seen a revision of that magnitude. And obviously don't want to get into the politics of all that here, but clearly the labor market has softened. The third area that we're watching is really the Fed entering an easing cycle here. The market is now expecting the Fed to start easing in September at their next meeting. And generally speaking, when they start easing, they continue to ease. We had a bit of a false start last year when we did have a cut, but it was kind of a one and done scenario. And so that'd be a big change from the tightening cycle that we saw in 2022, where rates essentially went from, call it 0 to 5% relatively quickly as the Fed was combating inflation. And so the market might be transitioning now into more of an easing cycle with interest rates coming down. And that has impacts on a lot of different financial assets.
Yeah, that's great. Thanks. I think that's a really good summary and a lot for us to discuss here and get a little bit granular on. So let's start with what you said about Magnificent Seven. And I know, as you said, we do sound like a broken record, but I think it has been the story of the markets this year. And you can really see it in the difference between the performance of the S&P 500 versus the equal weight. But talk about NVIDIA, and is it even more of a story beyond the Magnificent Seven?
Yeah, I think NVIDIA is probably the poster child for the AI theme. They've been growing incredibly fast. They're the leader in AI, the chips that really fuel the AI theme. And they are now today actually the largest stock in the S&P 500, and it's coming in at around 8% of the S&P, which we've never seen a company be that portion of the index. Apple for the longest time was the largest company in the S&P, and now Nvidia holds that. I think it's just more having Apple, Nvidia, really just that concentration overall is something that we haven't seen in a long period of time. And so we're bringing it up. But the other thing to keep in mind, we discuss, is this the 2000s? And a lot of people will bring that up, where the last tech bubble, and we always point to the difference this time is the reason that these companies are outperforming is they have all of the earnings growth. We put up something in the last 3 years, the Magnificent Seven growing 35 to 40% in earnings year over year. And even this year, they're expected to be 20%. So it's not necessarily just this big bubble and this hype. Valuations can be discussed, but really the big companies are driving the market higher in their stock performance, but it's being driven by the earnings growth, which is, it is what you want. We are looking for it to broaden out and for earnings growth to broaden out this year and next. And we think that'll be what'll be healthy for the markets going forward. But really, the last couple years, all of the earnings growth, or a majority of it, has come from companies like NVIDIA, and that's been a big driver.
Yeah, I mean, 8% of the index is truly a new high watermark. And I'm glad you said that about whether it's hyper bubble or whether it's justified. Just one more question on this. What about the role of AI innovation and adoption in terms of this growth?
Yeah, I think it's the big part right now. It's the big driving force. I mean, in years past, it's been cloud computing. The S&P 500 now is very driven by a lot of this AI. I think it's going to continue to be a theme going forward, not just for these companies. I mean, if you think of any corporation out there, if they want to be innovative, they're going to be incorporating it into their daily operations. And so it's an area of where we could see efficiencies and higher margins. And so I think not only in the companies that are tied directly to it, whether it be, an NVIDIA or a Microsoft, I think you're going to see it through a lot of different companies and hopefully get margin expansion. And so we do believe we're still in the early innings. That doesn't mean everything goes up in a straight line in terms of stock performance, but in terms of adoption, we still are pretty early. I mean, it was only a couple years ago that ChatGPT came out and kind of changed the game. You think of how long when the internet originally came, there was decades really where companies were building off of the internet. So we do think we're still early. It'll obviously not be a straight line in terms of companies' performance, and so we'll be watching that.
Yeah, great. Thanks. And the adoption is unbelievable, even anecdotally, right? My entire family leaped on it so quickly and generationally, which is amazing. You talked about the labor data and just a bit about the labor market data being a bit ugly in here, the recession word popping up again. Why do we focus so much on this data? And how is it that the labor data is coming in a little bit uglier? Yet, as you said in the webinar the other day, consumer spending, or RBC's report on the consumers are still healthy.
I think labor is one of the areas that we do spend a lot of time on, and we always say the biggest reason is it's a big driver of the US economy in terms of consumption. So the US economy is a consumption economy. Around 70% of it comes from the consumer. And so what we always say is there's a lot of people out there when you might have uncertainty, you may not feel as good, but what really drives demand would be is if you have a job or not. And so when, you have a weakening labor market, that really tends to make people make different decisions is when they don't have that job. And so the conflicting data that we spoke about would say, yes, we do have a weakening labor market. But at the same time, you've got GDP expectations are for 3% this quarter. You've got stimulus coming from the big, beautiful bill that has been, through in the US. And also you have CapEx that's really picking up right now. And part of that is, you now have a immediate deduction for tax purposes on capital expenditures. And so what we're seeing is with those revisions, maybe the labor market has been weaker in the past and it just hasn't really shown up. And what we like to do even more today as maybe some of this data is less reliable is just talking to the companies that we're invested in, whether that be listening to earnings call or presentations. And really we think different parts of the economy have probably already gone through their recession, whether it be trucking, parts of the consumer. There's been different areas. Housing's definitely gone through a slowdown. So whether it's been, rolling slowdowns as opposed to this one big recession coming at a certain point in time. But a lot of companies that we talk to are, as you say, they think they're doing better. The uncertainty really came through when the tariffs were announced, but now at least they see some goalposts that they can invest into. And so we're watching because if that labor market continues to weaken, that's generally what leads into a recession. But we are seeing pretty conflicting from the companies that we speak to, the outlook probably differs from industry to industry.
And you just mentioned the big, beautiful bill. Why is that important to earnings?
So that's important for a couple different reasons. Probably the easiest and the mathematical one would be the tax cuts that were put in place on the previous bill. If they didn't put this through, you would have had a headwind of taxes rising. And so getting that pushed through is important for tax cuts that are coming. There's additional tax cuts that are in there. And so that's more money into people's pockets that can be spent. And I touched on briefly, one of the biggest is if you're a company and you have capital expenditures, you can now immediately deduct that, whereas before it would come through as depreciation over a longer period of time. And so what we're expecting is, and companies are starting to do it now, you might pull forward and you're more willing to spend on these capital expenditures. And really CapEx it's harder to parse out, but it's around 15 to 20% of the economy. And you add into what already some of these, we spoke earlier, the AI theme, these mega technology companies are probably spending 200, 300, $400 billion on CapEx just to grow out the artificial intelligence structure that they need and the data, the warehouses. You add that into just Main Street now can deduct that capital. We think there's going to be a bit of a boom here in CapEx. And so those things coming out of the bill is, call it stimulus in general, not just from the government, but it's allowing companies to provide the stimulus as well. So that could help the economy going into 2026.
Now, we've spent a lot of time on this podcast talking about the US, and obviously a lot going on there, and we're highly impacted by the noise in the US. But the Canadian markets have been outperforming, and we're Canadian and we allocate a lot of our clients' capital to best in class businesses in Canada. Talk to us about Canada.
Yeah, and I'm glad you asked because we do spend time on the US a lot and it's because it's such an important country for the entire market. And but here at home in Canada, we've had to deal with a lot so far this year. No doubt Canada's going through a soft patch, a lot of tariffs, uncertainty, and as well we've just dealt with a poor labor market here. I spoke about in the US, we lost 65,000 jobs here in the last month. Our GDP came in close to negative 2% last quarter. And so the headlines are definitely difficult here at home. But I think one of the areas that we were focused on, because the Canadian banks just reported at the end of August and going through all of the transcripts there was something very noticeable compared to Q2. So they just reported Q3 at the end of August. They reported Q2 at the end of May. And when you look through, when we were reading the transcripts in May, it was all about the banks trying to risk manage, increasing their provisions for future credit losses, and really reducing any expectations they had at the beginning of the year, as any company would probably do at that time. If you think in May, we weren't sure what the trade situation was going to be like, where the economy was heading. And so a lot of them were looking at potential downside scenarios. Fast forward to the last earnings calls at the end of August, and there was a much different tone. Kind of surprising to us, actually, was that the banks were saying the consumers held in better than they expected. Actually, they continue to spend. Credit losses have not come like they thought they would. And so there was different CEOs and CFOs and on those calls basically saying, not that we're in the all clear by any means, but things were not as bad as they had expected. And there's a potential that we could even be on the higher end of where they had expected at the beginning of the year. So it's definitely a much different tone. So we could potentially seeing some positive changes there. And that's what markets really care about. So it's not to say that we're totally out of the woods yet, but the markets care about the future. And so if things aren't going to get worse in Canada, that could potentially be a positive. And I think you're seeing that, as you mentioned, in some of the Canadian markets being actually outperforming the US. They've only done that twice in the last 10 years.
Yeah, it is a significant thing to note here, isn't it?
For sure.
Yeah. Okay. So, Andrew, I just want to touch on before we start to wrap up here, I just want to touch on your third point about the Fed easing cycle and also on the 10-year yield. So, Bisson, he's really has been, and we've talked about this in previous podcasts, really focused on getting that yield lower. It's been a big priority of his. It's now at 4%. Why is that so important? What does it mean to how we think about credit, and how does that tie into the thought around interest rate cuts in the back half of the year or back quarter? I can't believe I'm saying that, but it's already the back quarter of the year.
Yeah. Just starting with the 10-year yield, if you think at the beginning of the year, I think it touched 4.8% or was near 4.8. And the worries was it was going to keep going to 5%. And when you start getting into those elevated levels of the interest rate, which, financial assets, they get priced off of the risk-free rate. And that US 10-year yield is what a lot of things get priced off of. And so the higher they go, it starts getting restrictive for the overall markets and the economy. And so that was a big worry. And not to mention, all the debt that is out there in the world when you start increasing those rates. And now that it's come down closer to the 4% level, it has eased some of those worries. So it's different from the Fed. As the 10-year, as they say, the Fed can't impact the longer end of the curve. They can only impact the short end. But that market-driven 10-year yield has eased, and it's really what Scott Bessent had wanted. Now, if we switch to the Fed easing, I think it's important to understand what the outcomes could be from that. And so we kind of have it as there's two reasons you ease. One is you're coming out of a tightening cycle, inflation's under control. Easing is generally good for risk markets. Everyone likes lower rates. It impacts the mortgage market. People can go out. It's easier on consumers. But there's one of two ways. You're either just easing for the sake of coming out of a tightening cycle, but if you're easing because you have a weakening labor market, recession's coming, and you're trying to stimulate the economy, that's not good for markets. So what we say is, depending on the path of the economy going forward is actually more important than just easing. So if you're easing and you're heading to a recession, it's probably not good for markets. But if you are easing and the economy continues to muddle along, it'll probably be good for risk assets and the equity markets. And in history has kind of shown that.
That's great. Thanks. That's a great explanation because it's certainly getting a lot of headline attention. So I always like to wrap things up with the podcast around our investment process. So has this changed our thinking, your thinking? How are you thinking about the investment process here?
We discuss everything. We're constantly looking at the economy and we're constantly looking at the markets. But really, what we're focused on here is trying to invest in the best businesses in the world. We're always spending a lot of times with management teams, researching companies. And really, depending on if you're going through an easing cycle or a tightening cycle, if there's tariffs, we always want to be invested alongside the best businesses and the management teams because we've found that they're best able to navigate anything that's thrown at them. And so there's a lot of moving parts. As you said at the beginning, markets are complex, but our investment philosophy really doesn't waver depending on the economy, depending on what's out there. We think the best risk management is the companies that we're invested in, knowing the companies that you're invested in.
Well, thanks, Andrew. That went by super quickly today. There's a lot to talk about on those three things. So I think we should probably wrap up here. But any final thoughts you want to leave for our listeners?
I think just the one thing that I think is so topical today is concentration. We touched on it on the Magnificent Seven and how important they are to the S&P 500. We didn't necessarily get too much into the Canadian markets, but it's even a very concentrated index in terms of just financials and materials. Gold is driving the Canadian market a lot right now. And so it's been very topical. And I think what it says to me is different equity markets mean different things. You get asked a lot, how are equities doing? Well, it depends if you're quoting the S&P 500, if you're quoting a small cap index, if you're quoting Canada. We think it's very important not to be focused on being overly concentrated in a single stock, a group of stocks, or even a sector. It's good diversification, and knowing what you own is really important now more than ever, and really prudent risk management, just because it seems to be like with this passive investment move, certain indices are becoming more and more concentrated into specific stocks or specific sectors. And so it's important for us here, the way that we invest, and I think it will continue to be going forward.
Well, thanks, Andrew. Really value your opinion, and I know our clients certainly do too. So thank you for joining me. And thank you to our listeners for joining us today. We'll be back next month with another issue of our KJH Insights podcast. Wishing everyone a happy fall season. And if you have any questions, please reach out to your portfolio manager or anyone on the investment team, and we'll continue to provide you with commentaries and updates as the market narrative unfolds. So all of those are available on our website at kjharrison.com. Look forward to speaking to you again next month. Thanks.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.